There really isn't much debate about the actual policy rate. Most people expect that to go up by 25 basis points when we get that decision in an hour. But people are looking for a little more clarity about whether this is actually the end or at least the pause in that rate hiking cycle.
So I think my view is that it is a pause, that they're going to do the 25 and then pause and just give time for the markets to absorb, the rate increases. And, we do know that the pace in which these rate hikes have happened has caused stress in the banking system. And so letting it pause for a while and sort of letting that filter through, I think, is going to be really important.
When you look at the severity of the rate hikes, basically going from roughly 0% to 5% in a year's time here, has that been much more of a factor, do you think, in the volatility we've seen in markets, or is it the actual absolute level of where rates are?
Look, in my lifetime, this is more. These rates.
This is nothing.
What you saw. Normal. Exactly right.
Yeah.
So it's not like that the banking system can't handle this rate. It's that the banking system is having a hard time handling the pace of which the rate increases have happened. And so, if you look at even back to SVB, I mean, this was a duration issue, which is directly related to how quickly the rates increased. And so I think that once we normalize in a pause, it's going to be a while before they cut rates. But I do think that the business model can handle them at this level.
When we talk about the economy and more importantly business activity, in light of the recent regional bank failures, but the broader concerns that you're going to see a retrenchment in lending and business activity coming out of the banks, both large and small, is that much more of a concern now, particularly when it comes to whatever recession probabilities we're looking for?
I mean, honestly, I think we saw retrenchment in lending by banks back to the global financial crisis when the rules changed around capital requirements. Again, SVB was investing in U.S. Treasuries. It wasn't a big loan portfolio. And so, yes, I think you're going to see even more of a retrenchment. I think that's where private credit has stepped in and will continue to step in. So I think that's a direct consequence of the change in the rules.
You've expanded a lot of Franklin Templeton's products into that space as well, right?
We have about $80 billion in private credit.
And why? I mean, was that driven by what your clients were asking for, or were you just looking for just a better place to offer?
So when we were looking at, and this goes back to probably 2017, and looking at the secular trends in investments, it is clear that not only are institutions increasing their allocation to private markets, but actually companies, for example, on the private equity side, they're just staying private longer. And, it's driven by a lot of factors, one of which that money was cheap, and so you had a lot of money there in private markets. But two, I think most CEOs would rather be in a private company than a public company. You don't have the same kind of pressure for quarterly earnings that you do in a public company. And so when we looked at that, we said our clients want more private assets. We need to be in that space. So we actually have acquired Clarion Partners, which is an $82 billion real estate manager, Benefit Street Partners in El Centro, which is about $80 billion private credit, and Lexington Partners, which is about a $65 billion secondary private equity, which, by the way, of all the secondary PE, to me, is just a great opportunity now from an investment standpoint.
Talk a little bit more about the secondaries, because when we talk about private credit, I mean, it's obviously much broader than what it used to be here. And when we're talking to people around Milken, they talk about this idea that you can have sort of a certain pocket of lending that will go to the middle market, maybe to sort of the riskier aspects of it. But there's also this secondary space, usually higher quality, that they're also chasing after.
So the way the secondary market works is, and let me take private equity. So there's been over $6 trillion deployed in private equity. Back in 2000, there were about 1,700 private equity-backed companies in the U.S. Today, that number is north of 10,000, right? And so from an investable universe, it's now massive. So you have these pension funds and other asset allocators that have a exposure on their balance sheet to the private markets. Their public markets, 2022, both your fixed income and your equity portfolios came down. Your equity portfolio was probably down 22%, fixed income 15%. You needed to pay pensioners, so you had to pull it from your liquid assets. But suddenly they're finding themselves, they call it the denominator effect, overexposed to the private market, over-allocated to the private markets. So they will call up a secondary lender and say, I need you to take some of this off my balance sheet and Lexington Partners will come in and they'll be able to pick which managers they want and which vintages they want and be able to buy those at a discount, taking into consideration current interest rates and the fact that there was $6 trillion deployed and about $120 billion deployed in the secondary. So there's not enough managers in the secondary space to actually absorb, all of the volume and demand. And so it's been a great time to get good pricing.
And a lot of the demand, I mean, obviously we know it's come from the big institutions, but now we're starting to see individual investors, wealthier individual investors, enter this space, and a lot of companies open up their products to a somewhat lower tier, at least on the income spectrum.
So the sellers tend to be institutions. Historically, the buyers tended to be institutions, but we've actually been very successful in being able to start bringing it to the retail and the wealth channel. To me, it's a great way to get exposure to the private equity market with a diversified portfolio, and also what they call the J curve, where when you first invest in private equity, the fees sort of make it so that you're actually down from your $100 investment might be worth $95 for a period of time, but that smoothed out in the secondary. You don't have that.
But when these strategies really became popular, it was because of a low rate environment. The idea that the yield and return that you can get, particularly in the fixed income space, just wasn't there. So you needed to find a better diversifier. You needed to find something with better return. Does that increase in interest rates over the last year change that dynamic, change that appetite?
So I think that has the potential to change it within the private equity space. But again, the secondaries are repricing it at the time they purchase the portfolio, and so they can take into consideration the interest rates. I think what we will see is you're going to see, some of the models that were just about leverage, that's going to be harder to do. Those that were more about restructuring and figuring out the best way to manage the business are still going to be successful even with higher rates.
What about straight fixed income? The idea of so much cash that's moved into either treasuries, and in many cases short-term treasuries, and even shorter term than that, just basically cash instruments.
I mean, finally you're getting paid to own fixed income, which is terrific.
Yeah.
A money market fund, you can get 4.75%. High yield, you can get 9%. I mean, these are liquid assets, which I think is actually impacting. Our private credit team would say they haven't had these kind of deals to invest in since the global financial crisis. A little bit of the challenge is that the traditional fixed income market on the liquid side actually is paying, great returns. And so the bar is a little bit higher to decide whether you want to tie up that capital or just stay short in the, and invest in the traditional markets.
It raises the question, too, about how clients are allocated right now. There was a lot of concern during the last bull market cycle. Everybody was in stocks. People used to joke about, being like 99% overweight equity, U.S. equities. Obviously, a lot's changed. I am curious as to, is the mix that we're seeing now in allocation, does that harken back to the mix that maybe we saw prior to the global financial crisis, prior to the dot-com boom?
Absolutely.
Yeah.
I mean, a pension fund usually tries to target 6.5% to 7% return. And so they can have a third of their portfolio now invested in fixed income and absolutely achieve that return. So, and taking risk off the table. I mean, one of the issues that I think was underappreciated during the time when interest rates were zero is in order to get return, you had to move up the risk curve.
Yeah. Now
they can bring that back a bit.
But is that risk that we talk about, is that transparent enough? And I'm talking specifically about the private markets.
Well, again, the risk on the private market, I'm not sure that the risk is liquidity, right?
Okay.
All right. So that's really the risk, because these people are, you're making a private loan in many ways because the banks aren't lending at the same level. They're getting even greater returns for the same risk level. The question is the liquidity, and does the investor understand it? And that's what you got to make sure they do.
But where is the liquidity? Because right now it seems all the liquidity is coming from the asset managers in the private space looking to push these instruments. I mean, we don't have the Fed liquidity anymore, and there's obviously, and what we're seeing in the public markets has changed as well.
Well, I think what has happened is that there's a risk that the banks aren't going to keep lending in the same way that they were lending, and so that's going to, from a lender standpoint, that's going to be in the covered by the private markets. And the question is, if you're a mid-sized company, can you get access to markets, and what is the cost of that access if the banks aren't continuing to lend in the same way? And syndicated loans loans, remember, we now require the bank to keep a portion of that equity on their balance sheets, which is very expensive. And the private credit manager doesn't have the same kind of requirements.
I'm just curious as to what clients are asking you in terms of just about their worries about the economic environment and all the things that have been fueling it.
Well, I think clients are asking about, honestly, the big macro themes, which are U.S.-China relations, right? What does that mean? Are there going to be restrictions on certain investors from being able to invest in China? What does that ultimately mean? I don't think anybody sees an end in sight for the war between Russia and Ukraine. So what does that mean from an energy, from a food security, and honestly, a little bit of this divide that you're starting to see between, friends of the U.S., friends of China, and then those parties playing kind of in the middle. And so a lot of clients are trying to understand, what does that mean from an investment standpoint?